Hi, this is Keith Schneider, CEO of MarketGauge.com, and it's October 23rd, 2022 edition of Market Outlook. So, very interesting week. We had a test of the breakout recently from the key reversal day from about a week ago. And basically, when interest rates on the short term improved this week, especially on Friday, diverging from the long bond, we got a really nice rally up 2.4% after actually opening lower. So, net, we've got an interesting situation. We have this low that was set in mid-October that was rejected with a key reversal pattern, and it looks like we're starting to confirm. So a couple of things. One, the Dow, out of the four key indices, very close to breaking out above the 50-day moving average. So, in essence, this swing point here, right, was actually violated and closed above it. That was a big improvement. Now, if you take a look, the other three indices actually have not taken out that important swing high from the beginning of October. So we need to both clear that level on the other three to confirm this rally. So the other interesting point here is that 3 out of the 4 major indices closed back above their 200-week moving average, with the exception of IWM. So take a look. The Dow really actually closing the best, certainly above the 10-week moving average as well. And as you can see, the S&P regained its 200-week, this green line here, and the same thing on the Qs. So we definitely have a technical bounce and working off the big divergences on market internals and market sentiment that were put in as the market made new lows. Okay, so now let's take a look at one key risk ratio, which is looking at the S&P versus utilities. One thing that's really clear is that there has been a great divergence and a risk-on situation starting since mid-September. And it's been steadily improving. And if you take a look, the S&P on all levels here outperforming utilities. That is a big positive. So net, this outperformance of the S&P versus utilities confirms a risk-on picture, at least for now. The other thing to note, moving on to volume, what's interesting is the volume patterns for the first time have also significantly improved. So you can see here, in terms of accumulation days, we don't have the 5 or 6 that says the market is under intense accumulation, but we do have more accumulation days than distribution across the board on all 4 indices. The other thing to note, which we haven't seen in quite some time, is that there are 0 distribution days in the Russell 2000. So as you can see, right now, the 30-day price trend in the Dow up over 5%, and that all pretty much happened this week. So significant improvement. Of course, year to date, we're still in bear market territory pretty much across the board, with the exception of the Dow, which again is not surprising since the Dow stocks have a lot more financial strength in general. So these rate rises not really impacting those Dow stocks as much as things like the NASDAQ or even the S&P. So there you have it. Big picture, definitely improving. The other thing, taking a look at sector rotation and performance as well, So what we have here is something that's also quite interesting and confirming the up action, which is number one, all sectors in the market for the week, right, were positive. The other thing to note, if we take a look at consumer staples, they were up 2%, less than half of the market, while consumer discretionary spending up well over double that. So spec sectors, semiconductors, also doing quite well. The one fly in the ointment here is the fact that energy and inflationary pressures was actually the strongest. So interesting to note, overall good performance, that sector rotation confirming sort of risk-on scenario, but the overhang of high energy prices still very much present. Now, finally, moving on to market hotspots. Let's just let it refresh. The other big themes to note is that Latin America, very sensitive to commodity prices, actually doing quite well. So you can see right here, Brazil up 11% over the last 5 days. So that's really good performance, and of course boosting Latin America as well. The other thing, with the prospect of interest rates slowing its rate of change, metal and metal mining was very strong as well. So you do have a situation where sort of risk-off type assets doing better with interest rates sort of pausing. So the one exception here, which makes things even more interesting, if you take a look, TLTs were actually leading on the downside, down over 5% on the week. It's only those short-term rates that sort of paused and were not down very much at all. And that is what the market has taken as its cue of what the Fed is going to do, and that rate of change in interest rates definitely supportive to a continuation of this short-term pop in the market. How long this lasts and the duration remains to be seen. Okay, one final note. The other thing to realize here is that the actual dollar index, which is a key component to the stock market decline and pressure on gold, actually eased up this week. So with the market up, the dollar was down, basically as a catalyst here on this jump in the market. So again, overall big picture is still there's inflationary pressure, although the Fed seems to be indicating a pivot, or at least the market thinks the Fed will pivot, hence the pause in the rise of short-term rates while longer-term rates continue to go up. All right, so net looks like the confirmation here of the divergence in signals that we've been talking about for several weeks is potentially now in play, further extending this rally. How far it can go remains in question. We got a lot of interesting things on the geopolitical front that continue to potentially pressure the market. And of course, central banks all over the world are under a tremendous amount of pressure, from Bank of Japan to the situation in the UK as well. So net, lots of interesting potential outliers, and so you just have to stay frosty and keep your stops in place. Okay, so that wraps up this week's Big View review. Good luck with your trading, and see you next week.